Welcome back, everybody, to the next session, number 3. Where have you been if you've missed the first 2 for today's Unique Manager Showcase, our sort of speed dating, which is kind of, I'm not sure it's quite speed or dating. Well, it's definitely speed, not so much dating. I'm very pleased to be joined by Alan McFarlane, Senior Partner at Dundas. And we're going to talk a little bit about the Heriot Global Fund, which is it's the global equity strategy that they run very successfully. But firstly, Alan, good to see you again. Now, the question says 2020 was a unique year, mainly because I want to avoid using the word unprecedented. How do you kind of look back at it? Because clearly the pandemic exercised a lot of our minds. We're in danger of sort of thinking too much about the pandemic and less about what actually happened as a result of it.
Well, let's see if it was unique. It certainly passes the test of particularly unusual. So the recessions, and I think we're much in the same age group, Lawrence, that the recessions that we have lived with up to now have been because of oil price shocks or bubbles in Japan or bubbles in tech stocks or just good old-fashioned recessions where people overinvest and get the credit decisions wrong. This one was an intervention by nature. So we talk a lot about ESG, and for the E part, generally we mean oil and gas and global warming, and for the G part, we mean boards and management and their incentives. But the S part doesn't come up very often, or not as much. And this was a year in which the S part of ESG was really important because it was a social year. It was a year in which our governments told us to stay at home, to protect the NHS or whatever health system we had. And in many respects, governments acted as a giant insurer of only resort. Because I know a number of insurers tried to avoid paying out on their business protection policies. Economies' success and wealth rests on exchange. And although we have become much more of a digital economy in society, particularly during the lockdown period, the majority of the economy still takes place face-to-face. And so by shutting that down by government instruction, we forced a recession. Never seen that before. It's a brand new thing. And when we're thinking about ES and G, we probably didn't put pandemic preparation, mass vaccination, health policies at the top of the list. So it was dramatic. How do we look back at it? It's proof that you can try and run a resilient business, but if the government says stop flying or don't go to hotels or you can't go to the cinema, there's no protection against that. And so we've learned the importance of exchange for wealth generation. And we've been reminded the importance that there is a thing called society and that it can be highly protective in difficult times. So I would say that's my personal and to a large extent the firm's interpretation of what happened. Interesting.
It's a shame we've only got sort of 15 minutes. So I can't really pick up on a number of things that you sort of said there. I think many of our viewers will remember the old expression, there's no such thing as society, used by one of our former premiers. Let's kind of move on because, you know, the fundamental part of what Dundas does with the Heriot Global Fund is kind of, you know, you're looking for dividends, you're focusing on sort of dividends, and you talked about resilience really of kind of businesses there. You know, how did the companies in your portfolio in the Heriot Global Fund sort of perform on the dividend front last year?
Okay, thank you. A word of definition, if I may. Dividend is not a synonym for yield. They are two different things. And we pursue dividend and capital growth. The dividend yield is the ratio between a company's dividend and its share price. Very obvious, but just worth reminding. Our portfolio generally yields less than global market indices, because we're pursuing businesses who can keep their dividends growing. Last year was a very tough year for over-distributing high-yield equities. So the numbers are in, we've got them here. So the MSCI ACWI, the All-Country World Index, almost the most representative index that is published, suggested that last year global operating profits fell 28% in sterling across the 2,000 plus companies in that index, which make up about 95% of global market cap, and dividends fell 16%. Now in the UK, it was worse. The numbers here from the MSCI's UK index, suggests that dividends were down 63%. Now, I may have made a typo in transposition, but I fear that it's that big a difference, because between BT and BP and Barclays and Shell, the UK's concentration in UK index concentration in some very mature businesses under existential threat, who bluntly paid out too much in dividends anyway, was made manifest. Of our portfolio, 85% of the stocks increased or maintained their dividend. Some omitted it under government suasion and are already returning. Some omitted and said, we're just going to wait and see what happens, but they're coming back. I hesitate to give numbers because we're just at the point of calculating all this, but content would be my answer to your question about our dividends.
And so going back to the kind of business model kind of part of it, the companies you've got of clearly you're looking for what we broadly call sustainable business models. And did your sort of view of what was a sustainable business model change a lot during the course of 2020 as a result of the pandemic? I mean, you mentioned sort of sectors like airlines and broadly kind of leisure, for example. They're not areas I think I'm right in saying that you're invested in.
We had no preconception against them. We'd have been happy to invest. And in fact, in aviation, we did have some investments in service companies that supplied the industry, but whose businesses weren't cyclical to travel levels, but they had to go because there's one thing about being not cyclical. There's another thing about having no customers. So they had to go very early, and they were two of our earliest, indeed our major cuts in the portfolio. As to your question about sustainability, we have to remember what we're investing in as a public company, and when we're investing in public companies. Customer, supplier, they meet over the exchange of goods and services for an invoice. And all we're doing is studying whether or not there are more of those interactions every day, and whether the profitability of those interactions and the cash generated permits the management to fund and feed the beast so that it keeps growing into the future. So it's partly backcasting instead of forecasting to see how good the financials are. It's partly assessment relative to other industries as to where growth is. So if you take PayPal, which we hold, which soared in terms of activity last year, and Lloyds Bank or Virgin Money Group, it really is like comparing, it's like before Roger Bannister in the 4-minute mile, there's somebody trudging round and then there's somebody sprinting ahead. So sustainability is not about buy it, leave it, don't worry about it. It's about fretting and analyzing how society and the economy are changing. And we're doing that through fundamental bottom-up analysis. That's an unfair phrase. By and large, the people I've heard talking about that kind of approach more are those who come top-down. We think it is much more reliable to address those questions bottom-up, and that's why we do it through stock picking. So yes, sustainability. Some of the ones that struggled will come back. The A380s are still there in the desert. The 737s will be delivered to Ryanair. So there's some things that have been avoided, but undoubtedly we have seen pandemic-friendly healthcare, testing, digital, online businesses accelerate, and we were delighted to have some beforehand. They were not bought in the foreknowledge of this event. They were bought in the expectation that they could deal with what came, and they have dealt with what came.
And clearly, one of the key sort of factors about having a dividend sort of focus is the ability of dividends kind of through a cycle, particularly when we may see slightly higher interest rates, slightly higher levels of inflation than we've been used to perhaps for the last 5 to 10 years. Dividends can protect wealth. Sort of on that kind of perspective, where do you sort of see dividends, and are you still clearly confident then in their ability to protect over time against those two sort of interest rates and inflation?
Well, excuse me, equity investment is risk investment. And the risk you're taking is that the company can sell goods or services to the customer at higher prices than their input costs. Blindingly obvious statement. So the question is, if those input costs rise, who's best placed to handle that change? The ones with the strongest business models, who are price setters and not price takers. And so high profitability, high return on capital would be defenses against those features. Now, you and I could have an interesting discussion about what inflation might look like. We would think it'd be a bump in the road, a speed bump, and not Ben Nevis, compared to the things we dealt with before. I'll say that I am skeptical of the risk of rampant generic inflation of the kind we saw in the 70s. But doesn't change the day job. The day job is to find businesses who have the potential to absorb cost, turn it into a value-added service, and maintain that pricing power to customers who want to buy it. It is so obvious to say that, it seems banal, but that is the core of what we do every day. Now, where pricing inputs to change, that might change who's winning more or less under those circumstances. So we would change what we did. As of today, we see no need to. And
you sort of touched on it there, and I spoke to the guys at Unicorn Income, but sort of pricing power is an expression that sort of fund managers used to use a lot, maybe 5 years ago. I'm kind of, again, age is getting the better of my memory, but it is effectively what you're saying there. Is pricing power returning as a theme, or has it never really gone away?
It's never gone away. That's why dividend. That's why I will not proclaim dividend growth as the all thing for everybody. It's what we've chosen to do, and the reason we've chosen to do it is that the only interaction that occurs between you and the equities you invest in, there are two. You can buy them and sell them, and while you hold them, you will receive a cash dividend if they're one of the great majority of companies that do that. And that cash dividend comes from all those interactions, including pricing power and so on. And it's what the board decides is tenable for this year. And since most companies regard dividend as a covenant that they are loath to break, there's some implication for what will happen in the future. We find, studying company financials and conduct, that dividend telltale trace in the sky is a pretty good basis for inferring what they think about their pricing power, their growth, and their prospects. So pricing power, cyclicality, inflation, they're all in the hopper. But what comes out the bottom, as far as we're concerned, is that long-run trend dividend growth and its sustainability. And all of the above are discussed every single day that we sit down around the table to discuss stocks.
And just we're getting down to our last sort of 2 minutes. If you were to kind of score yourself, rate yourself, and as a group as to how the Heriot Fund sort of performed last year, what would you give yourself? And kind of importantly, how does this sort of bode going forward for 2021 and importantly beyond? Because I think it's a long-term strategy you're running, isn't it?
It is. I mean, the turnover rate in the portfolio is under 20%. So we are buying and holding for the long run and saving costs in the process. Lawrence, you may know the infamous quote from P.G. Wodehouse, that it is never difficult to distinguish between a ray of sunshine and a Scotsman with a grievance. But so may I answer your question in the spirit of that, is to say we didn't fail last year, is the highest rank I'll pass on our pass judgment upon our activities.
I think that's probably quite a good way. It's almost like the Brian Clough expression, how are you getting on? Surviving.
Exactly.
Alan, really good to see you. Thank you very much. For anybody who's not familiar with the Dundas' Heriot Global Fund, go and have a look at it. It's in the IA Global Equity Strategy sector, I think I'm right in saying, and it's more than held its own. And there's some really kind of good thoughts from Alan and his colleagues on the Dundas website.